Okay, all right. So let's move forward. Now let's look at mutual funds, right? I think everyone knows what mutual funds are broadly. So you have mutual fund investors, then you have some people called mutual fund distributors. So these are the people who come and tell you where you need to invest. Okay, so they kind of give some sort of a mutual fund advice, and then you put your money into that mutual fund house, right? So it could be, say, Aditya Birla Group, or HDFC, AMC, or ICICI, or Prudential, etc. Right? These guys are professional managers, so they are going to charge the management fee for managing your investment, as well as they are going to charge distributors commission. And this distributors commission, they are going to pay back to the distributor. So for you instance, if you have been investing through a distributor, you would be specifying something called ARN. This ARN identifies who this guy is. So when that ARN is read by the mutual fund house, it calculates the amount of money this person has brought in and pays the distributor's commission. Now, the thing with this distribution commission is that it is an ongoing thing which is charged to you on daily basis. So when the NAV, the daily NAV is calculated and published, it's already adjusted for these two factors. All right. And so as long as you stay invested in the mutual fund, a particular scheme, your distributor will continue to get the commission. So if you invest for 5 years, he's going to get the commission for 5 years. Okay, he may not do any work after the first event, or maybe in between will come and he might give you some reports or may help you otherwise in between in kind of managing your other investments in mutual funds. But whatever investment you make, as long as the investment stays with the mutual fund house, the distributor will keep getting commission. Now, SEBI introduced, now one of the problems, sorry, let me come back to you. One of the problems which is there in this particular kind of model is that because the commission comes from here, it is quite likely that the distributor is likely to recommend funds which pays highest commission. And that need not be in line with what you're looking for. So there might be a conflict of interest which is brewing here, right? So SEBI in a couple of years back created another kind of intermediary which are called registered investment advisors. So Finance First, who we represent, we are registered investment advisor. And the way RIAs work is that, say, suppose you are a mutual fund investor, based on your situation, certain investments will be recommended, but no commission will ever flow. So what you are going to pay is just the management fee to the mutual fund house, right? So the cost of investing in that mutual fund goes down. But how does RIA make money? Of course, the RIA is going to come to you and ask you for the advisory fee. Now, the advantage with this is that because the fee is being charged to the investor directly, RIA is more likely to provide you advice which works for you. Because RIA is not dependent on the mutual fund house for its earning. It's dependent on the mutual fund investor. So RIA is more likely to represent investors in a better manner. Besides that, mutual fund distributor only advises you about mutual fund, while an RIA is a far more educated, far more experienced person, and he is going to advise you on the entire thing. Now, one of the key things which we talked about, right, is the configuration of your portfolio, your risk profile, the configuration of your portfolio, and the configuration of portfolio will have several, different elements. It could have mutual fund is just one of them. It could have direct equity, it could have debt, it could have gold, it could have real estate, etc., etc. So unless and until the person who's advising you knows in entirety what your goals are, what your risk profile is, it is very hard for him to configure the portfolio, right? So sometimes, some of the clients come and ask us, okay, Johnny, we got 25 lakhs of rupees. Where should I invest? I said, I don't know. I don't know where should you invest, because if I don't know your risk profile, if I don't know your entire portfolio, if I don't know your life goals, I don't know what kind of debt you are sitting on. I don't know what can I recommend. It's like, just should I just look at value research or money control and say, okay, this is the fund which is generating the highest return, hence you invest in that? It's a wrong kind of advice, right? So this is where the RIAs kind of significantly differ. So what the RIAs are likely to do, they're likely to make you invest in a kind of funds, mutual fund only, but they're called direct funds, right? So this is an example of a direct fund. I just kind of took out the printout yesterday. So this is the regular fund, Aditya Birla Sun Life Balance Advantage Fund Growth. This is a regular fund. If you are to go through the mutual fund distributor, this is the performance of the fund. And if you would have invested in this fund directly, this is the performance. It's the same fund. There is nothing different. The only thing difference is that there is no distributor commission here. That's the only difference. So you see, what is the distributor commission? If you subtract this, it's almost 1.2%, right? For 6 months, it would probably come to something like 0.6%. So that's, if you double it, because a 6 monthly period, it will go back to 1.2%. So this fund, the difference between the direct and regular fund is 1.2%. So if you were to invest in this fund, you would actually earn higher return. And how high this return can be, right? So I just took this 1.2% difference and took say 10% and 11.2%, where this 10 is a nice round number. And suppose you were to do SIP of 10,000 rupees and you did it for a period of 30 years. You know the difference between these two funds? In terms of maturity value, it's almost 70 lakhs rupees. Yeah. By going with the direct fund for 30 years and going with the regular fund for 30 years, everything else remains the same because it's the same fund. The 30-year difference on a 10,000 rupees, 10,000 rupees SIP I'm talking about. I know many of you might be investing a lot more, but just 10,000 rupees over 30 years is about 70 lakhs, or 25 years is about 30 lakhs, or 20 years is about 12 lakhs. Substantial amount of money, isn't it? Okay, and this is the reason why what I was telling you, that you need to ensure that you reduce the cost of investment. Okay, so look at the funds. Of course, you need to look at the funds who are doing well and are in line with your, portfolio configuration. But you got to ensure that the funds which have lower management fees, go with them, yeah, and go with direct fund. Now, only issue with direct fund is that there is no one there to advise you. However, you can always hire someone like us to advise you. But you might say that, okay, but Johnny, you guys are going to charge fee as well, right? The answer is yes, we are going to charge the fee. But in all probability, the fee which we'll charge would be less than the difference here. Secondly, you're getting a lot more. You're getting a lot more. Okay. We're going to advise you on the insurance, life insurance, health insurance. We're going to advise you on debt management, on your estate planning, will, retirement planning, tax planning. Now, just again, I'm just going to ask you this question. How many of you know, if you have been investing in the market, how many of you know what is the carry forward losses which you have in your investment portfolio? Does anyone know how much carry losses you are carrying forward? And do you use it effectively to minimize, tax which you would be paying this year? So this is called tax harvesting. All right, that's a very fancy name given to this called tax harvesting. So an RIA who works with you knows everything about your investment profile, your life goals, your portfolio configuration. So even it's not only that you talk to your RIA when you're investing money, you talk to your RIA when you're even liquidating, when you're redeeming. You've got to ensure that you do things so that the tax impact is minimum. Now tell me another question. Do you know that 1 lakh rupees profit on equity or equity mutual fund every year is tax free? And do you use that? So every year, technically, if you have more than 1 lakh rupees profit, at least you can book 1 lakh rupees profit and restart if the need. You can reinvest in the same fund again. But that 1 lakh profit you have taken in without paying any taxes, right? No one talks about it, because what we see amongst investors is the guy who does taxes different is maybe a chartered accountant. The guy who helps you with the investment which may be a mutual fund distributor who's only interested in the mutual fund part of it, and there is no one who's advising. And as we looked at it, as I kind of grew up the whole framework, investment is not about which mutual fund I should invest in. If you invest like that, God only can help you, right? You need to have a complete picture. So you need someone who can draw up the complete picture and who can tell you that what needs to be done. Okay, moving forward. Okay, so I think we are already 6. So I'm just try and kind of summarize and just take a couple of more slides. So investment in debt fund have two kind of risks: debt or debt fund. Yeah, whether you consider fixed deposit or bonds, NCDs, uh, mutual fund which invest in debt, government of India bond, etc., etc. They're all debt investment where you are giving loan to someone, right? So it has credit risk. Credit risk meaning the guy can default, and the interest rate risk is as interest rate moves up and down. If the interest rate moves up, you lose money, and if interest rate moves down, you make money. And tends to happen with the bonds which have higher tenor. So a 10-year bond will get impacted by interest rate movement a lot more than say a 1-year bond, right? So this is the broad profile. So if you look at your government savings bond, your national savings certificate, senior citizen savings scheme, etc., they are very low risk, right? Because they are from the government of India, so there is no chance of default, and usually a lot of them have a fixed rate, and you actually don't trade in them, right? There's no real liquidity event there, so you just sit with their bond with the kind of interest rate which is available to you and just go through that. All right, so you never exit, and hence you don't really experience the interest rate impact of the interest rate movement on them. Okay, those are the safer options. Gilt funds. So gilt funds are basically funds which invest in government of India bond, right? So they are called gilt funds. They have very low credit risk, but they have very high interest rate risk. So if you believe the interest rates are going to go down, these funds will generate enormous amount of return. So for instance, in last 1 year, gilt funds have generated close to 12 to 15% return. Yeah, because the interest rates went down. But if the interest rates go up, they will lose money. Then, a slightly higher credit risk would be bank fixed deposit, liquid funds, money market funds, ultra short-term funds. PSU and banking fund has similar kind of credit risk, because government-owned things and large banks is where the investment is usually made, but they are longer tenor bonds, so they tend to have interest rate risk, right? So your Bharat bond sits here, but technically, if you invest in Bharat bond and never sell, then it becomes somewhat like this, right? So it will appear somewhere here, because if you are not going to sell till the bond, the fund matures, which is what is the case with Bharat bond, say I think a 5-year, 3-year, and a 10-year maturity, then you are not going to experience the interest rate risk. Yeah. And if you go up, then corporate bond, credit risk funds, corporate NCDs, corporate deposits, they all kind of fall into this this metrics where you can say that these are the higher risk investments. So they will give you higher return potentially, but have higher risk, so you could lose money. Sometimes you have to be very careful, like ultra short-term fund. Franklin India had an ultra short-term fund which had exposure to some of the bonds which were in default or where the liquidity dried up. And so Franklin India had to shut, I think, one of their ultra short-term fund, right? So you have to really look at, when you're making that investment, you have to really look at what kind of things those funds are investing in. They're not riskless, right? If you hold for a long time, if you invest in a couple of funds, hopefully through diversification and all, that risk can be minimized, but you have to be very careful that, whether a fund is running after returns and ends up taking very high risk, because a lot of us, especially people, chase returns. They don't give a damn about the risk. They just chase returns, and they say, okay, these two funds look similar, and this fund has a higher return, so I'm going to go with that. But you really need to look at the portfolio of those funds and see if really they're really similar kind of funds, or are they sitting with slightly higher amount of risk. So that is as far as the debt funds are concerned and debt instruments are concerned. Equity MF, this is the way the risk is as far as risk is concerned. So large cap index funds have the lowest risk technically, then the mid cap and the small cap. Multi cap will lie somewhere here in between. Thematic and sectoral fund are technically highest risk mutual fund. And if you do direct equity and not have too much of diversification, then you would be towards this end. And this is what happens people who are sitting on the ESOP. Okay, you're sitting on ESOP, you have a very high concentration of your investment in single name, and people don't sell. I have seen many investors, and I tell them, okay, this is too much of a concentration risk, and you need to get out of it. They say, no, just 6 months back it was 50% up, so I'm waiting for it to come up to that level, but that level never comes, and it might go down further 30%. So these are the kind of challenges which sees and one sees, and you need to kind of manage. Then there are hybrid funds where the risks are relatively lower. So you have things like debt fund with a little bit of equity exposure. Then you have something called arbitrage fund, which uses derivatives like futures and options, but they do arbitrage. So they kind of work almost like debt fund, a low risk debt fund. Then you have balance advantage fund, which uses equity, debt, and some derivatives for generating return. And then you have equity and debt fund, which invests up to 65% in equity, 65% and more in equity, and remaining in debt. So this kind of gives you some sort of asset allocation happening through the fund, right? So that's what this is. The last thing which I want to put up is the taxation. Okay. Now, one thing which I want you to realize that I'll not put fixed deposit here, right? Fixed deposit is one of the least tax efficient debt investment, because whatever interest income you earn gets added to your yearly your income in the financial year and gets taxed at whatever be your income tax slab rate. Okay, and there is no provision of you saying, no, I don't want the interest this year, you pay it next year, right? Unless you have a compounded deposit, a compounded interest deposit. That also, but at maturity, the money will come, the interest will come, and you'll have to pay tax on that. So that is a challenge with fixed deposit, and hence, it might be a much better way to have the debt exposure through mutual fund, because mutual fund, if you hold for more than 3 years the debt fund, you have what is called as indexation benefit, which basically gets rid of the inflation effect. So you remember when we saw that first spreadsheet, I talked about 5% return, 5% inflation. So that kind of activity happens, and only profit which is over and above the inflation level is what gets taxed, and it gets taxed at 20%. And usually, thumb rule-ish, if you take the indexation effect into consideration, your tax rate is around 10%. Okay, so if you hold anything for long term, equity is at 10%, debt is at 10%. Technically, gold will also come at 10%. Real estate will come at 10%. Even if you invest in foreign equity, it will come at around 10%. I'm assuming that the inflation rate would be about 3.5% per annum. Yeah, that's the assumption I made. So staying long term in any of these things and configuring your portfolio through this instrument is far more tax efficient than anything else, right? So that's so fixed deposit. Maybe you want to use fixed deposit for keeping your emergency kitty or something like that. But otherwise, I would say that stay away from fixed deposit. It's very tax inefficient, right? And the whole idea is that ultimately the performance of your portfolio is dependent on the post-tax return on your portfolio. not the pre-tax. The pre-tax return has no meaning. Yeah, the post-tax return, because that's the money you really get after you pay out your taxes. So that's the end of the program for today.